Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome, everyone, to this Peak Prosperity Podcast. It is March 13th, 2018, and I am your host, Chris Martenson. Today, we're going to be discussing the global economy, inflation, interest rates, trade wars, things like that. Now, this is really a tale of two narratives. One goes like this. The global economy is hitting on all cylinders, U.S. equities just keep powering higher, corporate earnings are up, and both business optimism and employment are up. Okay, that's one narrative. The alternative one is that the risk of recession is high and climbing. Financial conditions are deteriorating, and both interest rates and inflation are rising. So which narrative is right? Returning with us today to help us make sense of all this, one of my very favorite guests, Steen Jakobsen, Chief Investment Officer and Chief Economist of Saxo Bank. He has many years of experience within the fields of proprietary trading and alternative investments. He travels widely, he reads and writes constantly, he thinks very broadly about the world and where it's headed. Steen, real pleasure to have you back with us today.
Thank you for having me, Chris. Always a pleasure being on your program.
Well, thank you. Now, listen, we last talked a little less than a year ago, and two major topics then were the declining credit impulse and the related risk of recession. Now, the credit impulse, it's a slow-moving beast. It requires many months of lagging to get it to align with economic growth or recession. Can you please bring us up to date with that story?
Yeah, and I think your last point is the important point. So basically what we know about the credit impulse, which for the listeners who doesn't know it, is the change of the change to credit, so the marginal change to credit in the world. And what we talked about shy of a year ago was, of course, that China has seen a dramatic drop in their activity, the second largest drop ever, only exceeded by what we saw in 2008, 2009. What we do know from empirical studies is that with a 9 to 10 month lead, we then know the economic activity level with 60% explanation value. In other words, mathematically, we have what we call an R square of 60. So 60% of the activity level is known 9 to 12 months ahead. Of course, that still leaves a good 40% unexplained, and here you can infer into the equation central bank policy, how active are they, but also certainly recently in the U.S. a fiscal imbalance that has increased through the tax cuts, and of course, the constant talk of infrastructure, which I think, Chris, we have been discussing among ourselves for the last 10 years. But the overall activity basically is that the credit impulse. And fast forward to today, what we're actually seeing is that we expect the Chinese impulse, as we look forward, to actually reach a trough in March, November. Meanwhile, the U.S. credit impulse has gone negative. So there we expect basically the global information we have right now is that Q3, Q4 this year is going to be very, very negative for growth unless the 40%, which is unexplained, picks up dramatically. And there we go back to your narrative. It's a tamping in tax credit that happened, or the tax help to the rich that happened. Is that actually going to push the needle in terms of the growth outlook? What will it do to inflation and the likes? But basically, the credit impulse is telling us we're still on route to have a slowdown in the U.S. economy. Some people will like to call it late cycle activity right now, and classically in the late cycle, business cycle, we do see inflation pick up, and we see that the companies on the corporate earnings side are doing extremely well. But that, if it's late cycle, of course, it coincides really well with the credit impulse.
Yeah, and in looking at this chart that I found of yours that's on, it was prepared by Saxo Bank, but it's on the trading site. The last time we saw negative credit impulses were, of course, declining and then tipped negative in about 2007, early 2008, also around 2000. So these things are fairly highly correlated with negative growth, but as you said, just 60%. So what about that other 40%? I have a question for you here. We had a little bit of a volatility scare in early February, and of course, a lot of people started passing me a chart showing that the U.S. Federal Reserve balance sheet was shrinking. But I kind of think of this as a global story, as we've talked about, and I'm looking here now at the ECB balance sheet. I can't see. It's actually just hit a new record, over 4.5 trillion euros, just an astonishing amount. Bank of Japan is their balance sheet is up 7.8% from a quarter a year ago. The ECB's up 4.4% from a quarter a year ago. The Fed's balance sheet is down 1%. Isn't it all three that we really have to look at?
Absolutely, and the Bank of England as well. So what we're seeing in terms of, I think the consensus right now, Chris, is that the impact on the G4 central banks will be the end of this year, which is kind of ironic that it coincides with my credit impulse signal. But basically, the net withdrawal of balance sheet overall for all four of the major central banks will start to happen as we enter into 2019. So the consensus, and I think a lot of the Goldilocks optimism that's built into the marketplace right now is exactly the people who look at that say, oh, hang on a minute, we know there's going to be withdrawal of liquidity, but that withdrawal actually in nominal terms will only start in 2019. What you and I have talked about with the credit impulse, of course, is the first derivative, the marginal change. And in my opinion, everything in life happens at the margin. Mm-hmm. But the negative margin change has actually been negative, but the momentum of the actual increase in balance sheet will continue until the end of 2018.
All right. So last time we talked, there was some risk of recession baked into that. I recently saw that there's been other talk of recession risk out there, by the leading economic indicators, all this and that. Where do you stand on the idea of first U.S. recession and then secondarily maybe global recession? Yeah,
so I led my prediction of recession being, led by the credit impulse, because if I have 60% explanation value, I actually think that's, the way to go. What I've seen recently is a number of papers that look at the term structure of the yield curve in the U.S. And if you use that, we've seen a significant increase over the course of this year, of course, from less than 10% to 25%. I think consensus in the marketplace is probably 10 to 15. I think the math is about 25. And in our estimation, we are still north of 50% recession, exactly because we think the credit impulse is happening, because we believe we are late cycle. And because if you look at the expectation for 2018, what's interesting is that the EBITDA expectation for this year in terms of the earnings for companies is higher than any actual earnings has ever been in the S&P 500. In other words, the expectation, even if met, will not be a phenomenal result, but it will be the highest ever. So not even having the highest earnings ever would actually be a big beat on the expectations. So where in other years when we started talking this time of the year, as we come into the tail end of the year, normally we will see a revision to the downside. This time we actually start with very high expectation. It's like the market is priced for perfection right now. We have a benign policy out of the White House, according to the market. We have a benign Federal Reserve in terms of its steering of the interest rates, according to the market. And in terms of the recession, the market is saying, well, we have enough fiscal impulse to carry over for another period. And finally, on the monetary policy, again, benign, because really 2019, it will start to withdraw the liquidity, but 2019, we will have much higher growth to pay for that. So that is sort of the Goldilocks setup that we have right now. And I'm not one to say that you should absolutely go short or anything, but in our quantitative models, it's very interesting that this spike in volatility we did see in early February has meant that our quantitative models, which are very, very dynamic in nature, they've gone to the highest cash levels we've seen.
Now, so I'm intrigued by this idea that let's go through that Goldilocks policy piece by piece. That this idea that we have on the fiscal side. It seems pretty relaxed. And of course, Trump is talking about in the United States, infrastructure spending and all of this and that. What I'm looking at here, though, is the spike in the deficit is already pretty extreme. And that's going to require floating, I guess, another trillion of new borrowing over the next year if the numbers are right. How does that get absorbed, and what's the impact on the dollar here?
Yes, so there is a theory, which I actually think works, that the more supply there is, the more net demand there is. So in a leveraged society, in order to deal with the debt, what we classically seen is that supply creates its own demand, which of course is Say's law, probably one of the few laws in economics that work. So basically, by increasing the amount of issuance, there will be a net demand for it, because for every marginal change higher in interest rate, right now guided by the Federal Reserve, there will be pension asset and liability manager buying it. So I think in a mathematical point of view, I don't think it's an issue that the issuance increase, and I think that's what the market is pricing in. I do think credit impulse is negative because that equates to the credit cake being smaller. So unless you increase the leverage, so leverage times the amount of credit that you need, then you have an issue. And I think that's exactly what's going on. I think the leverage ability of society is going down. I don't think the net issuance per se will be an issue. There will be enough demand for every marginal 10 basis point higher interest rate to see. Don't forget that a lot of pension funds and insurance company will actually make money as interest rate goes up because their net liabilities will decrease significantly.
Right, great point. Of course, the pension funds are in many cases so far behind the eight ball. It's I'm not sure exactly.
But that's a different story. The fact is, isolated in trading wise, as long as interest rate is rising, it's actually very beneficial for pension funds and insurance companies.
Well, sure, I could see that, and maybe particularly for the corporations that have to set aside and put money into their pension funds. That absolutely makes sense. So, but let's talk about these rising interest rates for a second, because this seems to be potentially a pin in this story, something sharp and pokey. So here's what I'm looking at, Steen. I'm looking at the LIBOR chart, and it's positively spiking here. It's faster even than the 2011 mini crisis. It's at a pretty high level here. What's going on with LIBOR right now?
Yeah, so the LIBOR rate, of course, is interbank uncollateralized lending as well. So when you look at the TED spread, so both the LIBOR on its own, but also the TED spread are increasing significantly, and that actually shows you that there's a less amount of credit available. Of course, I will argue that it's due to the credit impulse in the world and the contraction of overall credit, and I think generally the banking system is unprepared. I mean, I don't think they have the net funding going on in the banks anymore. Despite the fact that net lending is not increasing significantly, I think the balance sheet is actually very stretched in the risk-weighted and all of the compliance that they need to do. Don't forget the maximum leverage of U.S. banks has gone down from, in the case of Lehman, 50 times leverage to now less than 10 with the new Federal Reserve regulations. So I actually think that there is too little capital going on.
Too little?
Too little capital, free capital people are chasing in using the money in other like ETFs, in passive risk parity and others. So I actually think the available for credit to credit is significantly decreasing. And I think to some extent there's still a distrust between certainly across borders, and the recent regulation in the U.S. of course have also made it more difficult for foreign banks to go to the Fed window to borrow money.
Interesting. I don't know if you saw it, but Raoul Paul of Real Vision TV put up a very interesting chart on Twitter a couple weeks back, and it showed the stock price of Deutsche Bank inverted against the LIBOR OIS, and it seemed to be a pretty tight match. He was suggesting that maybe Deutsche Bank is exposed here as part of this dynamic. Is that a possibility?
Yeah, but probably the explanation for that is also pretty clear. So what happened with the tax deal in the U.S., of course, was that the U.S. company was allowed to repatriate capital to the U.S. I don't think that there wasn't actually for major and medium-sized company any tax advantages. But it does sort of screw up the money market system because don't forget that these money was always in dollars anyway, but they were sitting in an Irish bank or in a French bank or a Luxembourg bank as euro dollar, not in euro dollar the currency, but in euro dollars. Now that the U.S. companies are then repatriating the capital from the European side of the bank and putting it into a U.S. banking system, actually the money goes from being available to the global market and goes into the domestic U.S. market. So part of the fueling of the stock market has actually, in my opinion, come from this increase in liquidity domestically. And what we've seen, on the other hand, is that cross-currency swaps and, as you say correctly, LIBOR rates between banks and Deutsche Bank and other European major banks have actually had to pay up to get the funding of U.S. dollars.
Interesting. All right. Well, let's keep on this interest rate bandwagon for just a minute. I'm looking at corporate yields here, investment grade, also rising, highest level in years. Pretty interesting here. So even as that liquidity is sloshing back in to the U.S., it's looking a little bit like funding costs are still going up here at a fairly highly indebted moment in time. Aren't these rising interest rates, what are these telling you? It looks to me like there's less liquidity in the system, which is why I made the comment about financial conditions, but maybe there's another explanation.
I think every single product that the investor look at has less liquidity than is perceived. I think one of the biggest gaps between perception and reality right now is the ability to actually exit the portfolio in right now, whether that is an ETF, whether that is credit, or whether that is even some of the small cap stocks. And I think we already have a proof for this because the spike in February, think about it, it was just about a 5% move in terms of price, but it created almost a 10,000% increase in volatility. If a 5% move create that sort of noise in the system, it shows you that we again, and I think I used this on your program before, but we're playing musical chairs. And when the music starts, we're not missing one chair, but we're going to be missing 3 chairs in a 10-chair race, right? So I think it's pretty clear that the liquidity side is as a concern. And I can tell you, this afternoon, an unnamed central bank called me up, and they wanted to talk about liquidity in ETFs and the bigger risk of the market itself, being it itself in terms of the way we have structured the market today. So I actually think that the liquidity is the norm now. And if you look at the breadth of the stock market over the last couple of weeks, it's very, very, very narrow. So we are chasing the same investing, we're chasing the same themes. We are not concerned about, as I said before, everything is benign when we talk about the incoming risk, but I'm very concerned, and I'm certainly, apart from me, and I'm always wrong pretty much, but at least my model, my quantitative model is now supporting me, saying we really have to be in a mode of capital preservation now. This is the capital preservation mode.
So I'm interested in this that comment about the market structure. I've done a lot of interviewing with people over the years about the rise of the machines, the algorithms, all of this and that, and of course we saw in that February volatility that liquidity and volumes just absolutely evaporated, as one would expect in a market structure that's dominated by computers, algorithms that are very, very rapid and quick to pull the bid when they need to. Was that part of the discussion? And if so, how does that feed into ETFs?
Yeah, so first of all, people treat ETFs like it's a stock, like it's a homogeneous entity. A lot of the ETFs have specific rules in market making. They have specific rules in end of the day pricing. If you have a leverage ETF, it's a total different. You have a counterparty risk, but the thing is that the market now has gotten so used to trading ETFs, they think everything is the same, everything has the same standard. There are a number of standards involved in just in the ETF side, and then you have derivatives on that and the likes. In our estimation, there's about $4.5 trillion worth of ETF and related products right now in terms of active investors. And that's a significant chunk. And most of this is intransparent, not intransparent because the ETF is not declaring properly, but because the investor doesn't read that declaration of what happens. And a good example, of course, being these 2-3 times leveraged VIX ETFs that you saw. So as per usual, I think we are all taking the easy choice and the easy way out in terms of just, we like a theme and then we buy the theme. We forget to look at the actual counterparty risk. We forget to look at the liquidity involved. And don't forget, every single crisis, every single person that ever gone bankrupt in history, they went bankrupt not because they were stupid, not because they did something wrong, but because there was no liquidity.
Interesting. And what about the market structure being so dominated by algorithms now? Yeah,
so first of all, if we just step back, why is algorithm so big, and why is it pretty much for 98% of it really short-term based? Because if you are using artificial intelligence, if you're using algorithm, you need deep data mining. But deep data mining actually have a prerequisition of at least 60,000 data points. And although you and I, Chris, combined are very old, I don't think you and I have any databases with 60,000 data points, right? So if theoretically, mathematically, we could not do deep mining of our data. But imagine you then, instead of doing daily data or weekly data, did minute or seconds data, then easily you get 60,000 data points. So what I'm really trying to say here is that the reason why we have so much algorithmic trading in short-term trading is that's the only way you can actually fulfill one of the mathematical minimum requirements, which is 60,000 data points. But it also means that almost all of the activity is in between intraday, really. So 90% of the flow intraday is driven by algorithm, but That leaves the rest of the market, like over the week, over the month, to be end users of real risk. So I think the distortion is really in the short term. But reversing back to your point, which is that, but isn't that the exact reason why it's so dangerous? Yes and no. I think there's plenty of liquidity in the system, but day by day, these algorithmic traders can disrupt and can switch off the engines that actually provide the liquidity. And that is the bigger issue. And especially in the ETF space, where you have so many creations of ETFs. So don't forget, if you're an institutional investor, you don't go buy HYG, for instance, but you go to a provider or your bank, and they will issue you a tailor-made HYG out of the subcomponents, right? So you specialize these ETFs. And of course, that liquidity disappears. You were around in 2008. You probably knew a lot of people who were long the CDS on failure, and when they needed a bid, it was pretty much the same price where they bought it, right? So the bid-offer spread went from 1%, 2% to 50% spread.
Right. So yeah, and by the way, I can't get to 60,000 data points because as I add one, I kind of lose two at this stage of life. So what are you gonna do? Right. So, hey, so I'm interested now in looking at really what's going on with these trade wars and this idea. It's really on everybody's mind. A lot of rhetoric flying around. But Steen, should a trade war evolve here? What's at risk?
It's big. It's massive, and I think. Of course, being a foreigner, I'm not a bespoke expert on U.S. politics, but I do know for a fact that the only issue on which Donald Trump has been consistent, even before becoming political, has been on this bashing of China and early on of Japan in the late 80s. I think it's a central part of his appeal to the voters. I think he's playing a midterm election game right now. And I think the whole political narrative they created is that after World War II, the Marshall Plan was put to work to help the Europeans. The 2001 WTO inclusion of China was also a lending hand for the U.S. to help China to democratize and move on. And now I think Trump wants to unwind all of this. So the narrative he and his advisors have used is to say, well, now we first help Europe, we help China, they have not been kind to us, now we want to reverse this. Of course, the practical side of this, of course, is that even if Trump was able to create all these manufacturing jobs that he dreams of, they would be unproductive and uncompetitive, and they would increase the inflation pressure in the U.S. And this is bad inflation, not coming from increasing activity, but actually coming from taxes going up. So the great irony is, I think, the hardest hit on this would be the U.S. consumer. They will get higher prices for all products. But most importantly, from an economic point of view, if you think about the U.S., you've been running a current account deficit for many, many years, courtesy of being a reserve currency. If you run a current account deficit, you're actually spending more money than you have. So let's presume that Trump is successful. He reverses the trade deficit to a surplus, and in the process, the current account. That will mean that the U.S. consumer will have to be living beyond his means, or be below his means for a long, long time to come back to a norm. So it's extremely complicated, but I do know that people are underestimating this. Look through the history of America First as a slogan, Pat Buchanan, Second World War. I mean, the whole concept is this dream about yesteryear and a time past where American cars and everybody was happy in the 50s and 60s, and this is not the reality of the world. On the other hand, though, it's pretty clear that China and other countries are violating property rights and other things. So you need to clamp down. But this escalation out of Twitters and the likes is not the conducive way. And I think the single biggest risk, if we all combine everything we talked about, to growth, to a recession, is actually the gentleman Navarro and Lighthizer in the White House. I think those two advisors are directly probably culpable on seeing U.S. growth go lower if they're successful together with Ross to implement some of these trade sanctions against the rest of the world.
Well, I guess there's two ways to sort of get what Trump says he wants in terms of trade policy. One would be to have that trade war. The second would be to have a much weaker dollar China's probably going to have to respond at some point beyond rhetoric. And I'm looking here now, killed or abandoned under Trump, a list of things, of companies that have been blocked in terms of takeovers in the United States since Trump took office. This Qualcomm one that just got blocked, the would-be acquirer Broadcom, based out of Singapore. The next country that got blocked after that was China, then China, then China, then China, then China, China, and the last one on the list is Germany. So it really is beginning to look a bit like Trump's got a point to make here. How could China respond beyond allowing the dollar to weaken?
To expand in the One Belt, One Road, to go for, I mean, don't forget, since we talked, we've had the Communist Party conference, and the Chinese then said, we are no longer aspiring to number one, we want to be number one. And as you know, aspiring to something and wanting and expressing that you want to be something is very different. So I think what we will see over the next 10 to 20 years is a very clear de-dollarization from the Chinese and the Asian region. The first step in that is actually the Shanghai Commodity Exchange, which in March will introduce a crude contract. China is the biggest importer of crude in the world. Why would they want to go through a U.S.-based contract to do that when they have a third party involved? China wants to get their currency to be stronger so it can be a reserve currency. They will probably have to build up their reserves in gold to match what is already in place with the IMF and Europe and the US, about 10 to 14,000 tons. So I think China's policy is pretty clear. They're going for the long haul. The long haul is that they have ability to create infrastructure and strategic alliances all the way through Asia and the Middle East. And using that leverage and their purchase and net demands leaves them in a better negotiating position, as seen from Beijing relative to the U.S. So I think very shortly, and maybe even in this year, a lot of people will have to, a lot of countries, a lot of prime ministers will have to decide, are you with the U.S. or are you with China? And unfortunately, I think a lot of people will be with the Chinese in this situation, partly because of the policy implemented by the U.S., but also for just the pure mechanics of it. Think about it, there are about 4 billion people in Asia, and if we are very, very nice to North America, there's about 600, 700 million clients, right? So the companies that's going to be built and produce and sell in Asia will have an audience which is at least 4 times, 5 times, if not 10 times bigger than the ones that is in the U.S.
And it's
so that's the response, Chris.
Oh, very, very well thought through. And I've been astonished noticing that, because of all the anti-Russia, if I dare say, hysteria, but the focus that seems to be pretty outsized right now in the West. We saw Exxon back out of a Rosneft deal, but China's energy fund, CEFT, stepped in
up
and bought a big piece of that.
Yeah, I see it live when I'm traveling. So in Moscow, I stay in a specific hotel which is used by diplomats. Last time I was there, the King of Saudi Arabia was there. First time ever in Russia. I went to, where did I go? I saw that the Chinese foreign minister was there. As I travel around the world, there's another new alliances being built, and what American companies will say right now, we are not going to be allowed, as per your definition as well, we're not going to be allowed to compete in China, but then we can certainly compete in India, right? So India being, soon the most populous country in the world. But hang on a minute. So if you look at the history of India, who does India has the highest common denominators with? Where is most of the bureaucrats in India actually educated?
I wouldn't know. England?
Russia.
Really?
So Russia and India has a very, very close. Russia has always, by India, been seen as a close ally. So Russia and India are very, very close. So of course, if you line the countries up along the sort of the split world that I gave you before, you would say, well, but China is given we can't do, the Chinese can't do the U.S. So then there is Europe left, which of course will always be in the middle. But India is sort of the up-and-coming country that everybody wants to be a piece of. They have already strategically aligned themselves with Russia, and as they have aligned themselves with Russia, will also ultimately down the line align themselves with China. So what I see, unfortunately, is, Chris, that down the line we're going to have a split world where Europe sits in the middle, and then you're going to have the eastern countries ruled pretty much by Chinese economy, and you have the Western U.S. part that is becoming increasingly isolated. And in between all of this, I think this cryptocurrencies that's going on. I think one day pretty soon we will have an IMF currency. We'll eradicate all the currency rates, and then the governments will use blockchain and cryptocurrency to control us even more, including global tax and the likes. I know I'm getting depressive now, but I really think this is what people are trying, the policymakers are trying to achieve, and which they can't get away from. So the response is pretty clear to me. China is going for 5 billion people plus as the home market. And they're not going to be, too worried about the U.S. as an export market, because I think they know it's already over in terms of its ability to be a big exporting nation into the U.S.
Yeah, that it certainly seems to be something that's maybe hit its peak at some point in time. But it's, to me, tracking the energy markets and watching what happened with that delegation from Riyadh that went to Moscow, but also went to Beijing, and watching that whole realignment, it really feels like the United States is living in a prior era strategically. I'm not really clear what our strategy there is, but if it's alienate the world's top oil producers, we're doing a great job. We seem to be proceeding apace on that one. Hey, speaking.
Yeah, I really don't think I don't think it's per se it's a strategy to be in the to upset people. I just don't think they understand how the world has evolved. I think China is so misunderstood by Westerners, especially English-speaking Westerners, and I think, but by that fact, we underestimate the tenacity and the ambition of China. China is really to be the number one country in the world in every sense of the word. And as you know, I know you a lot of alternative energy and computer powers. They have the world's two strongest supercomputers. They did the first quantum telecommunication satellite recently. I mean, there is a number of areas where actually China is superior to the U.S. in research and abilities. So it's not all just stealing IP. It's also a very, very grand and ambitious plan to be number one in the world in technology, because the technology is the way they can maintain high growth rate through increasing productivity.
Well, and they certainly also understand resources and how they play out and where they are in the larger energy story. And they're making what I consider to be rational moves, given what I see in the data.
The electrification, I mean, that's a big story since we also talked last, right? There's going to be flowing more money into battery and battery storage over the next 12 months than there's been in the last 120 years, right? So on the positive side, I think we are going back to fundamentally not doing apps, but doing more of mechanical engineering and combining the biggest big data, all the stuff that we learned over the last 10 years, not to be on Facebook, but actually for energy consumption, storage of energy. And I really think there'll be, think about China wants by 2020 all cars to be electrical.
Yeah,
you can think about that what you want, but it's the government that says it should be, so they will be, right?
Yeah, and it's astonishing.
A country with even bigger pollution problem is India. 5-10 years from now, they're also all will be going to electrical cars. So the world is changing, and an electrical car is just a battery, right? Don't get me wrong, it's sophisticated, but you will not have like German industry. I think the German industry is the U.S. is behind. Germany is really behind. It's in a different time age. They have no expansion of the electricity grid. They don't have investment in electric cars. They don't have. They are built on doing what we did in the 60s, 70s, and 80s and 90s, right?
Mm-hmm. Well, now I'm interested, though. Let's turn back to Europe for a second. I can't wait to get your views on this. The Italian vote. It certainly seemed that the Italy vote, from this end, it looked like the Eurosceptics gained some measure of power. The Italian banking system looks like a mess to me from over here. How does the Italian vote change any of the calculus now for Europe?
So again, there are two narratives. There is that, did you really expect anything different to happen? And the second one is that, it's late in the cycle for Italy. To some extent, the less diplomatic person than me would say that Draghi's whole policy at the ECB is actually keeping the Italian banks alive. Mm-hmm. And as Draghi leaves the ECB by March 2019, I think Italy basically has a year left on this ability to change. And with this election, I think what unfortunately transpired was that Italy is as far as it's ever been from actually sitting down and figuring out how they do reforms and how they get the banking system in order. So to me, I think the Italian banking system is a ticking bomb. I don't think it's an immediate bomb that will explode, because as long as Draghi is at the ECB, he's going to continue to support and have a very loose monetary policy in Europe, pretty much based on the fact that they will keep Italian banks alive.
Well, with 20% non-performing loans, let's be clear, they're already zombies.
Absolutely, but the zombies at a very low level of interest rate. So when you pay zero in interest rate, it's not a big deal. But if the bullish crowd on interest rate are right, and we're going to be at 4 hikes from the Fed, and then I think it will be. And as you said already earlier, with the LIBOR and the TED spread, and overall the interbank lending being somewhat drying up, I think these banks need funding, and they need constant funding from the ECB and from the system. So yeah, I mean, I recently traveled to what I say is the 3 most leveraged countries in the world, which is Norway, Dubai, and what was the third one I was thinking about? Anyway, but both Dubai and Norway is 2 countries where you've seen the real estate market come down dramatically, 10-15%. And in Dubai, despite the fact they have the World Cities thing coming up. And that's because they're the most leveraged societies that I know. These are high-risk taking countries, and all of them are actually reflecting the same story. And Italy, again, is not a high leveraged risk, because, of course, the domestic saving is very high in Italy, and most of the issued bonds they have is actually sitting with pensioners and pension systems and the investors in Italy. But the fact is, I think the problem will show up first in Italy, in Dubai, and in countries marginally like Norway, where you have small open economies which are very dependent on the global trends. And I think we are seeing cracks in the surface. But again, ECB, central banks, I think it's still ready to take another dance with easy monetary policy if the Goldilocks scenario unlocks.
Yeah, so I want to talk very quickly then about this idea of where this inflation might come from, because certainly inflation will push on rates. We've seen a tick up in inflation here in the United States, consumer price inflation at 0.5% for January. That annualizes out at 6%. Don't know if that'll stick, but very interesting chart, commodities versus equities, that ratio at one of the lowest points in decades. Is it in your mind, is there any danger that commodities, which would actually push through to more consumer inflation, that those might actually begin to go up here?
I think the 2 asset classes that has a positive return expectation over the next 2 years are emerging markets and agriculture and commodity overall. So I actually think they will push up, but for reason not related to inflation. I think simply because the extraction price and energy consumption is decreasing. So I think there is a good deal to be done there. And I think overall, as a proxy, tangible versus intangible. So yeah, you're absolutely right. They are extremely dirt cheap relative to any assets that you can compare with. So I think over a 5 to 10 year period, these are the assets that will do well. In terms of the inflation story, I think both Goldman but others has also pointed to the fact that the interest rate rise we've seen, if you decompose that, 80% of that is actually increase in not in inflation expectations, but in growth expectations. So 80% is actually people predicting higher growth, and only 20% has been higher inflation expectations. Personally, I think the whole upside of inflation is extremely overblown. To me, inflation comes from velocity of money. Velocity of money in the U.S. is still poor. And if you look at velocity of money as a definition, it's actually net lending demand from the banks. And as you know, Chris, the net lending from banks in the U.S. has just gone negative. So I don't understand how structurally we're going to get higher inflation in an environment where banks are lending out less money. The multiplier is working slower, and velocity of money doesn't seem to be picking up. Of course, what could change that would be infrastructure. It could be CAPEX expenditure, so increased funding. But what we've seen so far in 2018 has been that companies are still buying back stocks to a tune which is bigger than the net issuance of bonds. And this infrastructure, I think, is very difficult to implement in the U.S., certainly because, as you know, most infrastructure investment actually happen at state level. And state level tax issuance is not something people like to do in a midterm election cycle.
No, absolutely not. Hey, I have a quick question that I'm hoping you can answer. I don't have a good answer for it here. I'm looking at the ECB balance sheet here at their website. I'm looking at it lists a variety of subcomponents, of course. I'm interested in two. The first is gold and gold receivables. What exactly are gold receivables, and is there any way to find out how big that component is?
I presume it's gold swaps.
Mm-hmm.
So they have lent out their gold to create liquidity in the marketplace.
Yeah, so that's the same thing over here. I can never find any information on it. That's where the inquiries end. They just say, no, we have gold receivables.
Yeah, exactly. I don't think they actually want to be seen to be lending out their gold, but I'm pretty sure they do. And as you know, there's a huge amount of conspiracy theories on how much gold is actually in the vaults and what quality, right? But in terms of the accounting, I'm pretty sure it's gold swaps, so the ability to actually lend against the stock in vaults.
Yeah, interesting. I'm still trying to unpack that. It's very tricky to get any good info on that. The second category is other assets. I love that. Other assets listed at 254 billion euros. Seems like a big number to me. What might be in that other bucket?
That could be, well, I mean, technically things that is not normal bracket, and it could also be, and I know where you're going with the question, so I do think that there could be some equity and other stuff and swaps related to, so may not be buying directly stocks, but they could have been buying return asset swaps and other things on what they do. Plus, of course, they could have bought some protection on some of the bonds, the risk they've taken on.
Yeah, it's just, our own Chicago Mercantile Exchange lists proudly on their website a central bank incentive program. They're the highest volume players out there, so they get really special pricing. But not one central bank will list that they actually own any CME products, but they all have this giant other bucket. So I'm just interested.
Yeah, I think the Swiss National Bank is the exception to the rule. Like Swiss National Bank, of course, is a big stockholder in Apple, so you can see their actual positioning.
Yeah, and direct stocks, but they've never admitted that they own a CME future or put.
No, true.
I haven't seen that.
And I don't think we will see that change either.
Yeah, probably not. So I'm just curious. All right, to wrap up, Steen, what are the biggest risks you see for the remainder of this year, and how does that have affected your hedging or positioning of your portfolios?
So I think the external factor is what is now coined the trade war. I think the market is totally unprepared for the severity of the fallout from that. I think in market terms, it's the market itself. I still think that the February, quick rally we saw in volatility is only a precursor to what could be coming later. I think the market is really priced to perfection, and I don't believe in perfection after a long life in trading. So the market itself, and I say overall, what really concerns me but I hope I'm not, but if China and the US is going to split the world in two, we really stand in front of a very difficult time to re-engage, because at least in prior crisis we had a global market for better or worse, but this time we could have two versions of the same thing, and I don't think China will back down. I don't think the US will back down.
Interesting. And so in terms of positioning portfolios, is it time to lighten up here, go to cash? So
I've said a few times, we are in what we call a preservation of capital mode, which means that you should definitely still keep exposure to the market, but you should do it in a way which is unleveraged, and you should certainly increase the cash proportion to have some ammunition should there be opportunity in the year. And I think there will be opportunity this year. Guessing whether the magnitude of the fall is going to be 5, 10, or 15%, I don't know. But I do know if a 5% can set off the alarms as it did in February, God forbid we get a 10 or 15% move down for the marketplace. But having said that, I think the incoming changes to CAPEX in terms of electrification and better uses of these new technologies, I'm pretty positive. I think from 5 years from now, we can store energy at 1/10, if not 1/100th the price that we do today. And imagine what that can do to the world in terms of cost and applicability of alternative energy sources. So
that would change everything.
That will change everything, and I think it will change, and we need it change. And I think there's a higher order, Chris, and maybe end by being a little bit philosophical, but I think if this is the world, we should be depressed. If this is how the world looks, but I actually think over the next 10 years, we're going to go to a higher order of things. I think computer power, energy, as we just talked about, starting to educate again and understanding that IQ and investment in education is everything. I think we're getting it. I think we're getting it very slowly, and there's a lot of noise politically. But I think the winning companies of today are knowledge companies, social intelligent company, and I think this drive will be away from digitalization and stupidity towards quality and service. So I'm very optimistic about the future, but I do still think, unfortunately, that we got to have this reshaped sell-off before we can start anew.
Well, as you know, us Americans can always be counted on to do the right thing after we've exhausted all the other options. So
exactly. But that's not just Americans,
I know.
to be fair. That's everybody.
I know. I'm just quoting one of my favorite curmudgeons of history. So, hey, with that, Steen, thank you so much for your time today. Tell people how they can follow you and your excellent work.
Yeah, so we have a research webpage that is called tradingfloor.com, and if anyone ever wanted to follow what I specifically write, just put a note on my profile there, and I'm very happy to share my thoughts.
Fantastic. Well, Steen, thank you so much for your time and your insights today.
Thanks for having me, Chris.